Okay, so now we're on to 8.2, the very short compared with the last one, about constructing optimal portfolios. And again, I'll do some things in Excel to illustrate this, but there's only 4 slides or 5 slides, won't take very long. So this is about portfolio optimization with crypto assets and maybe with other assets as well. In other words, trying to find portfolios that have a lower risk but a higher return. Maximize the return and minimize the risk, or maximize the risk-adjusted returns. That's what we want to do in our portfolios. So you'll recall that the return on a portfolio with weights W1 to Wn on assets with returns R1 to Rn at any time t is given by the weighted sum of the asset returns. So W1 times R1 plus Wn times Rn. And the returns change all the time, and it's difficult to keep the weights constant too. But when we do risk measurements, we hypothetically keep those weights constant to analyze the risk of the portfolio. The reason the weights are going to change too is that the weights on all the assets will change every time the return on one of the assets changes. So, for example, you might have $1 million in Bitcoin and $1 million in Ether, and so the weights are 0.5, 0.5. And then the price of Ether doesn't change, but the price of Bitcoin does, and maybe the price of Bitcoin goes up. So instead of $1 million in Bitcoin, you've got 1.1 million in Bitcoin, but you've still got 1 million in Ether. So the value of your portfolio is now 2.1 million. And the weights on Bitcoin and Ether are 1.1 over 2.1 and 1 over 2.1. So it's something like, 0.52 and 0.48. The weights always add up to 1. Unless you are making them add up to 0, because what you're going on with long on one, you go short with another. But for what we call a fully funded portfolio with no short positions at all, always long the assets, the weights will add up to 1. Now we can use the rule for a variance of a sum that I've just written out here, the variance of 3x plus 2y is 4 times the variance of x, 9, 3 squared is 9 if a is 3, 9 times the variance of x plus 4 times the variance of y. And using that rule, we can apply it to the sum above, the return is the weighted sum of the asset returns, and have this horrible long formula you can see here, which I don't really want to go into. It just took me forever writing it out, not using LaTeX, and I was exhausted by the time I finished. And anyway, it shouldn't really be written like this, but you may well have seen this type of formula, maybe with just 2 or 3 assets. But when you've got n assets, it gets like really, really long. Why have I done this? Well, it's because that's the equation we can use, and I'm not going to do it, to prove the principle of portfolio diversification, which is a fundamental thing that you've learned since your first year. And the way I like to say that is that when the assets in a portfolio have returns that are less than perfectly correlated, then the volatility of a portfolio is less than the weighted sum of asset volatilities. So looking up here at the first equation, the volatility of these returns is going to be less than W1 times the volatility of the first return plus Wn times the volatility of the nth return. So we can use the variance formula, remembering volatility is like standard deviation, so it's like a square root. I won't go through the mathematics, but as long as these assets don't have perfect correlation, and if they had perfect correlation, they'd be essentially the same asset because they'd always move exactly 1 for 1. So yeah, that's the principle of diversification. Have more assets and lower the volatility. Now, we're going to write it in matrix form because I have to do this in Excel and I can't do that horrible formula in Excel, but I can do this in Excel. So this is just a bit of matrix algebra. W is the vector of portfolio weights. So, you know, it would be, let me show you my screen here. Oops, some paper. Here we are. So suppose we have for example, we've got 1 million in Bitcoin and we've got 2 million in Ripple. Okay, and we know that the correlation between Ripple and Bitcoin returns is 0.5. We know that the volatility of that one, so this is the row between 1 and 2. I've only got 2 assets there. So say the volatility is 50%, volatility 60%, shall we say. So that's all the information I need to find the portfolio volatility. How do I do that? Well, first of all, my weights vector, little thing underneath this W, is the vector of weights, which is 1/3, 2/3, yeah? Because you've got 1 million and 2 million invested, a total of 3 million. My variance matrix, the elements of this are the volatilities, the variances along the diagonal. So it's 0.5 squared, 0.6 squared. And then the covariance here is going to be, well, let me make that 0.8 so it's different. 0.8 correlation times the 2 of those, 0.5 times 0.6. And similarly here, it's 0.8 times 0.5 times 0.6. So that's my V matrix. And so I need to do the matrix computation 1/3, 2/3 times this thing. So 5 5 is 25, so it's 0.25. That's 0.36. 6 5 is 30.3 times 0.8 is 0.24. Okay, and then 1/3 and 2/3. I'd rather not put those in decimals because otherwise we'd have lots and lots of 0.333333s. Okay, so I need to do that matrix calculation and I'm going to do it in Excel. But that is what this formula at the bottom means. The V is a symmetric matrix, meaning that the covariance term, i.e. correlation times the two standard deviations, they're the same, and the diagonal elements will be the variances, and then the W is the vector of portfolio weights. So back to me. Hello. Here's another example. Suppose Bitcoin returns have a volatility of 60%, Ether returns have a volatility of 80%, the correlation is 0.65. Find the variance of a portfolio with 1 million invested in Bitcoin and 3 million invested in Ether. So the weights are going to be 1 and 3, so total is 4. 1 in Bitcoin, so that's 0.25. 3 in Ether, that's 0.75. And this is the covariance matrix, that's 0.6 squared, 0.36. 80% squared, that's 0.64. This is the covariance term, 0.312. Then we've got to do this, okay? So it gives me the portfolio variance is 0.5 and the portfolio volatility is square root of 0.5, which is about 70%. All right. Now, to get optimal portfolios of crypto assets, there are lots of different ways that you can reduce the volatility by selecting the weights in what we call an optimal portfolio. It could be optimal because you've got equal weights. It could be optimal because you are minimizing the portfolio variance. Another form of portfolio optimization is to choose weights to maximize something like the Sharpe ratio or some risk-adjusted returns. There's lots of different ways to optimize portfolios, and I'll have a look in Excel to show you what to do. And in addition to that, you can apply various constraints, such as no short sales or targeting a required return. So you want to minimize the variance, but you need to have at least a return of 10% per annum or something. Okay. So there's lots of there's 100 different ways to optimize portfolios. Once you've optimized, you've chosen your optimization model. Could be the Markowitz model, like the very first slide I showed on this topic. Mean variance optimization is what we call that. We need to have something called risk aversion to do that. And you've probably come across that in your investment theory module. I'm sure you have. You've probably come across this as well, how to measure performance. And there's loads of ways. There's 101 different performance metrics that could be applied to measure the performance based, and what you need is a historical time series of portfolio returns. The most common are the Sharpe ratio, which is the mean of that historical time series. And then you take off the risk-free rate and divide by the standard deviation of that time series. Or the Sortino ratio. The thing is that the standard deviation regards any deviation from the mean as something big. And that's what it measures, deviations from the mean, upside as well as downside. But we don't necessarily mind if the returns are positive and way above the mean. We worry that the returns are negative and way below the mean. So the Sortino ratio is very similar, but instead of dividing by the ordinary standard deviation of the historical time series of portfolio returns, you divide by something called the downside standard deviation of that series. And then you could have the Trainer ratio. That would be the mean return minus the risk-free rate divided by the portfolio beta. The Omega ratio, that's a bit different, but there are so many different performance metrics. This is not a module in investment theory or portfolio management, so I'm not going to go into them. I just want to touch on them briefly at the end of this long module on blockchains and crypto. This is the very last slide. Hey, you got there. Just a bit more Excel to watch and then you're done. One thing to note about the Sharpe ratio and the Sortino ratio is that they're usually quoted in annual terms, a bit like volatilities. That means all the quantities in the Sharpe ratio, the mean return, the risk-free rate, and the standard deviation all have to be annualized. And usually when you look at a risk-free rate, if it says risk-free rate is 1%, it means per annum. It doesn't mean over the next day, obviously. It wouldn't be risk-free if it was 1% over the next day. So as you know, we annualize standard deviations using the square root of time rule. But mean returns, are like variances and covariances, are annualized not using the square root. Same factor, but don't take the square root. All right, so let's have a look at that in the next video and do all that in Excel. Bye for now.